After a tumultuous first quarter for global markets with extreme highs and jagged moves, the first week of the second quarter is looking quite calm so far. We've got the US and China trade talks this week. We've got the rather secretive Brexit negotiations. They've already begun, while global debt is soaring, driven by emerging markets. We've got the political debates happening in France this week as well, so we'll mention that. Lots to talk about. We've got Peter Dixon of Commerzbank joining me now. As I say, lots going on, but what is the market driver this week? Because I couldn't pick one out.
No, I think you're right. In terms of the one thing which is driving markets, it's hard to pick one out. I mean, I think we are struggling with the after effects, as it were, of last week. The Article 50 discussions, I think, continue to reverberate. We've got South African worries rising up the agenda. But as you said, it's hard to pick out any one thing which you could say that's the market driver for this week.
Yeah, and when it comes to Brexit, as you say, we're coming off the back of this igniting of Article 50, but it's all very secretive anyway, so we don't really have anything to kind of cling on to, except for the sterling.
Right. Well, I mean, if you look at sterling, yeah, we had a little bit of a stronger move yesterday, which I thought was quite surprising in the event of all that's gone on over the past few days. But you're quite right. I mean, we're not going to get any substantive movement on these discussions until sort of May, June anyway. So that's a couple of months of relative quiet on that front. So I think it'll give the chance for politicians, domestic politicians perhaps, to talk a lot. Maybe we'll get a little bit more out of politicians in other European countries to get a sense of what they want. But overall, I mean, I think it's going to be a case of the markets are going to be filling in the gaps. Yeah,
let's talk about France then, because we've got another TV debate happening this week. Is that a main driver for European markets?
I don't think the markets are that concerned about France, funnily enough. I mean,
really?
They would be concerned if the event went the wrong way as far as they're concerned. I mean, they'd be very concerned if Le Pen were to win the presidency. But I mean, obviously that's not until early May, so we've got a month to get that out of the way. But I think at the moment, with Macron marginally ahead in the polls, it looks like it's going to be a Macron-Le Pen runoff in the final round. Obviously, many a slip and all that, but that's how it's looking at the moment. And all the evidence suggests that if that's what we get, that head-on-head race, then clearly Macron will win, possibly by a decent 60-40 margin. And in that sense, obviously we won't have anything to worry about. So I guess the markets are saying, well, we'll worry about it even when it happens.
Okay, and getting back to the economics, when we look at the European markets, we've had some really solid data releases. But if we look at these growth figures, do they mean anything if we take away inflation?
Yeah, I mean, to be fair, I think the European economy is beginning to turn a corner. You're quite right. We are seeing some pretty decent survey numbers. I think it'll take a while for that to feed through and start to impact upon, the big picture numbers like GDP. So, I mean, give it 3 to 6 months. But, I think we're on a solid footing. And, so long as nothing happens to derail that prospect, such as, politics or whatever, I think we can look forward to a decent 2017, possibly into 2018, as far as the European markets are concerned.
Okay, let's switch over to the other side of the pond, because there's a very important meeting happening today with probably two economically of the most powerful men in the world, Donald Trump and Xi Jinping. We've got the US trade number coming out later on today as well. Donald Trump is on a mission to get rid of this deficit, $500 billion worth of a deficit. Is he going to be successful in this?
I think ultimately not, because you've got to accept that in a globalised world in which many American firms indeed have outsourced their production to other parts of the world, you're always going to be re-importing, as it were, your own produce. And to be fair, I mean, what's happened is that over the course of the last 20 years, countries such as China have become effectively the workshop of the world. And basically what's happened is it's driven down the cost of production. In other words, it's driven down the cost for US consumers of buying certain consumer goods. So it isn't actually necessarily all in the worst interest of the US that there is a trade deficit. You can argue about whether it's too big. Obviously, Mr. Trump feels as though it is. But I think that if you were to go down the route of trying to put in place measures to perhaps block Chinese trade in any way, shape or form, that could have some very serious negative repercussions for the US and, of course, the rest of the world.
I just want to mention emerging markets. I know you spoke about the Rand in South Africa, but I just mean as an eclectic movement, because they've got to deal with a strong US dollar and an enormous amount of debt, astronomical debt now. I feel like something's bubbling away.
Well, I mean, you're quite right. I mean, I think that the debt and the dollar are linked, aren't they? Because obviously it's the dollar-denominated debt which is going to be a problem. If the dollar continues to rise, then clearly you're going to be putting pressure on these economies in terms of their ability to service debt. So clearly there's an issue there. But I think so long as the emerging markets continue to grow reasonably strongly, and there are signs, I think, that they've turned a bit of a corner, then hopefully they'll be able to generate sufficient income to at least service their debt. So I don't think I'm too concerned. I mean, you're quite right to express some worries, but I don't think from where I'm sitting now, it looks like it's going to be a sort of a bomb which is going to go off anytime soon.
Okay, where's the weak spot and where's the sweet spot right now?
Ooh, well, I think when it comes to weak spots, it's really all about the geopolitics, because markets get concerned in the face of uncertainty. It could be France, it could be something happens with regard to Mr. Trump. I don't know what it is, but I rather suspect that that's the thing which markets are concerned about. In terms of the sweet spot, I think it's fair to say that it takes something like 8 to 10 years for economies to recover from the kind of shock that we had in 2008. We're getting into that window now. So I think the global economy is on a solid footing. If you want to look for a relative sweet spot, actually, funnily enough, I quite like Germany. If you look at, say, German equities, they're relatively underpriced compared to their US compatriots. The economy is beginning to gain a little bit of momentum. I think overall it's a place where I'd be quite happy to put some money at this stage of the cycle.
Okay, and we've got the elections coming up there, in September, isn't it? Time too. Also as well, we never really know what's going to happen because we had the St. Petersburg terrorist attack happen yesterday as well, so it just shows you we've all got to be prepared for anything happening. But thank you very much indeed for that, we appreciate that. Talking about the drivers of the global market this week, thank you for watching.